My name is Jeffrey Muriuki from the School of Business and Economics. I'm going to take you through in Financial Accounting 2, BAF1201, specifically in a topic, financial statement analysis. And through financial statement analysis, we are going to restrict ourselves to ratio analysis. Financial statement analysis or financial statement are prepared at the end of the year as the final account. And there are various types of financial statements that may prepare at the end of the year. One of it being income statement, statement of financial position or the balance sheet, cash flow statement, statement of change to the equity, and note to the account. Financial statements are normally prepared to be used by various users of the account. But before the users use the account, this financial statement need to be interpreted so that we can ease the decision making. There are various ways you can use to interpret the financial statement, but in our case, you are going to use ratio analysis. Ratios are of various types, of 5 classes. We have liquidity ratio. We also have profitability ratio, turnover or activity ratio, leverage or gearing ratio, and then lastly, we are going to talk about liquidity or investors ratio. We start with liquidity ratio. Liquidity ratio normally measures the ability of a firm to meet the current obligation at the fall due for payment, or in other words, the ability of a firm to make or to pay the financial obligation or short-term obligation at the fall due for payment. When we talk about the current financial obligation, we are restricting ourselves to those obligations that are payable within one financial period or one financial year. To be able to pay the current liability, we require the current asset or those assets that are disposable within one financial year. So on one side, we have the current asset. On the other side, we have the current liability. We are asking ourselves as we make the interpretation, do the current or are the current assets that we already have in a firm enough to clear the current liability? So in liquidity ratio, actually, we are comparing the current asset with the current liability so that we'll be able to know whether we are in a better position to clear the liability at the fall due for payment. One of the liquidity ratios that we are going to look at is the current ratio. It is given by the total current asset, you divide by the current liability. And then the second ratio we are going to have is the quick ratio, also referred to as asset test ratio. In this ratio, you normally take the current asset minus stock or inventory, then you divide by the current liability. Remember, at the current ratio or the first ratio, we took all the current assets. We are comparing all the current assets with all the current liability. But here, we are not taking all the current assets, but we are lessing the inventory. The inventory is normally deducted for 2 major reasons in this case, in the asset test ratio. One of the major reasons is that we may not tell with certainty when you are likely to sell the inventory. Remember, we want to assess the ability of the firm to clear the liability at the fall due for payment. Now that probably you want to take liability for 1 month, how sure are you before the end of that 1 month you already have sold the stock or inventory that you already have in there is the stock? We may not tell with certainty. So it may only be safe when you're using the asset test according to asset test ratio to deduct the inventory. We may not tell with certainty. Another reason, we may not tell with certainty the much we are going to recover on sale of the inventory. Remember, the assets or the current assets are being used as a security for the current liability. But now, with the inventory, as you're saying, we may not tell with certainty how much are we going to recover on the sale of inventory. So we may, under this ratio, we are deducting inventory because of those 2 scenarios so that we can reduce the risk of what you don't know. And then lastly, we have the cash ratio. Cash ratio is given by the cash plus short-term marketable security. You divide by the current liability. Here we are using we are not using, we are just using the cash as a short-term marketable security to compare with the current liability so that you'll be able to assess whether you're in a position to meet or to clear the current liability and therefore due for payment. You can see you are nodding down. The reason to why, or before you come to this, short-term marketable security are actually those securities that, we don't have them as in cash, but they can be accessed anytime. If I give an example, assume you have some shares in a good company. You can tell with certainty that within 2 or 3 days or within a very short period of time, you already have sold the securities. Or probably have some cash in fixed deposit account. You can tell with certainty that within a given period of time, I'm going to be having that cash in my current account. It's just a matter of giving probably 1 month notice or probably 3 days or 1 week notice. So you can tell with certainty that I'm going to have this cash within a specific number of time. You may be wondering when you are supposed to use any of these ratios, whether to use current ratio or quick ratio or cash ratio when you are making decision. As I'll be trying to explain, it all depends with the scenario. For instance, assume that you are to get the credit for 1 week. We may not be comfortable with the current ratio because we cannot be sure with certainty that within 1 week you have already sold the stock. We cannot even be sure or tell with certainty that within that one period of 1 week, you already have received from data. So it is only safe in case a credit period of 1 week to use the cash ratio. But probably if the credit period is 1 month, we may choose to use the quick ratio whereby even the data are also included. And still, if you think of current ratio where the period is a long period of time, probably 9 months, 6 months, we can tell with certainty by the end of those 6 months, we already have sold the stock, and therefore we can comfortably use all the current assets to compare with the current liability to see whether we are in a good position or we have enough liquidity. Then we go to profitability ratio. Profitability comes from the word profit. And when you think of the profit, it's the main issue at work with the business. We want to generate as much profit as possible when in a business. And when you're assessing the profitability ratio, we normally analyze them in 2 major categories. Number 1 is profitability in relation to sales, and number 2 is profitability in relation to investment. Actually, when in a business, we normally think of profit in terms of probably 1, the amount of sales that you are making. The more the sales that you are making, probably the more the profit you are likely to generate. The more the investment that you have done in a business, probably you can say the more the profit you are likely to generate. Although it is not always true that the more the sale, the more the profit. Probably the margin is quite small. Or you cannot even say the more the capital invested in a farm, the more the profit you are likely to make in that farm. So that is the essence of having the profitability ratio. And at the sales, we have the gross profit margin, whereby you take the gross profit, we compare with the sales, you multiply by 100. Then net profit margin, we take the net profit after tax, you divide by the total sales, then you multiply by 100. And at this, you want to calculate for every shilling of sale that you make, how much is the profit you are generating out of that 1 shilling? So that you can say, in future, if you make a sales of 1 shilling, out of that 1 shilling, I'm going to make a profit of X much. Then you have the profitability in relation to investment. And the investment, we can look them at the 3 major categories. We have return on investment. Then we have return on capital employed. And we can narrow down to return on equity. Return on total investment is actually seen as the total asset. This is the total asset that you have in the farm. What is your total asset? That is what we refer to as total investment. And that is what is going to give us the return on investment. In other words, we want to see out of the profit you are making, what is the percentage as we compare with the total assets that we have. We don't just want to invest for the sake of investing. But ahead, we want to compare the profit you are making with, we compare with the total investment that you have done in the business. So total asset, and it can also be calculated by taking the total equity, which is the same as capital, plus all the liability, which are made of current liability plus non-current liability. When you go to capital employed, we are narrowing down. We are now not looking at the total asset, but we are deducting the current liability from the total asset to get the capital employed. Another name for capital employed is the net asset. So we take the total asset minus the current liability. Or if you are starting with the other side of the equation, then you take the equity plus the non-current liability so that you can see the capital employed, the long-term capital. You know, you don't want to use the current liability when you are talking about the capital employed. The last thing, we now down to net worth. Net worth is the wealth of the business. What belongs to the owner? What the owner can call theirs. Remember, non-current liability, although they are being used to finance the business, it does not belong to the owner. So we take only what belongs to the owner of the business. And that is what we refer to as the equity or net worth. Net worth, you take all the liability, all the asset minus all the liability to get the net worth. And that is what is giving us the various type of ratio. Capital employed, you take the net asset, you divide by the capital employed, you multiply 100. Then return on investment, you do the same. Net profit, you divide by the total asset. And lastly, we have the return on equity, whereby you take the earning after tax, you divide by the equity or net worth. Then we go to turnover ratio or activity ratio. We also refer to them as efficiency ratio. Actually, efficiency ratio normally measures the ability of the firm or the extent to which the firm is using the resources available to be able to generate sales. And there are various resources that you may think about. You may think about the stock as one of the resources, the data as one of the resources, ability to get the good or credit, that's another resource. The capital invested or the machinery that you have or many assets that you have, they are also resources. So to what extent are you able to use the resources that you have to generate the sales? That is what we want to calculate. The frequency of using the resource to generate the sales. And that is why you normally refer to it also as turnover ratio. For instance, in case you are talking of inventory, to what extent or what is the frequency of changing the stock to sales? You have the stock. How many days do you require in a year? Or how many times in a year do you change the inventory to stock or inventory to sales? In case you have data, you are not just holding data. No, depending on the frequency, you are going to adjust the performance of the business depending on the frequency of these resources. For instance, in case you are able to sell many times in a year, then that business may be seen to be performing good. The first ratio you are going to have is the inventory or turnover ratio that is given by the cost of sale. You divide by the average inventory. So you ask yourself, so actually average inventory is the much inventory that you normally have every year or every day. So on daily basis, how is the inventory in the stock? Then the cost of sale is the total sale that you have made in that particular year. So if you take the total sale that you have made in a certain year, you divide by the average inventory every day, then you're going to have the number of time you have made sales in a certain year. Assuming that, for instance, that average inventory is normally 50,000. It means that in case you have sold 100,000 sales, you have only sold 2 times a year. That is why you take the cost of, say, in a case it's 100,000, you divide by 50,000, so that you can see the number of times you have made sales in that particular year. Then after you have seen the number of times you have made sales in a particular year, you normally take the number of days in a year. In a case you take 365 days or 12 months, you divide by the inventory turnover. For instance, in case you got the inventory turnover or the number of times that you have sold in a year to be 2, of course, you are going to take 12 months, you divide by 2 times, so that you can get, on average, how many months do you require before you are made a sale. In our case, probably you may think of 6 months. Another resource we may have is the data turnover that we normally take the credit sales, not the credit sales, not the sales, the credit sales in a year per annum. You divide by the average data. I remember the average data, like for the stock, is the number of data or that data in every day. So they take the total sale, divide by the average data to get, on average, how many times do you make sales per year, or the frequency of making sales. I remember the more the frequency, the better the business. You are analyzing as the user of the financial statement probably to see the best business to invest in. Then you have the credit turnover that tell us about the many time that you have bought goods on credit. And after getting the credit turnover, then you can comfortably get the credit period by taking the number of months you divide by the credit turnover, or 365 days divided by the credit turnover. Then we have the equity ratio. The equity ratio, they also refer to as shareholders ratio. When a shareholder is investing, your major interest is what you're going to get out of that investment. And the shareholder normally get return in form of dividend from a company. So we want to compare the much you have invested in form of share with probably the much dividend that you are getting from that company. One of the ratios that we're going to have is the earning per share. Here we want to calculate for every shilling that you invested in form of share in that company, how much are you earning for that 1 shilling? So that eventually you'll be able to say, on average, if I increase 1 shilling in form of share, how much dividend am I likely to get out of that 1 share? Otherwise, you don't just invest for the sake of investing. You must ask yourself, how much am I getting out of the much investment that I'm getting? Then you have the earning yield, whereby here you want to compare what is happening in the market with what the company is earning. So you compare the earning with the price in the market. And actually the price in the market is what is happening in the stock exchange. So you compare the much the company is giving you, giving the shareholder, with the much the market is giving you. Then you have the dividend per share, whereby you want to compare also the dividend with the much share that you have in the company. So you want to find for every shilling, how much dividend am I getting? And then you have the dividend yield, whereby you compare the dividend with the market price of the share. Then the dividend cover is the amount of the dividend. Remember, when you are paid dividend, you may not be paid all the amount of profit. So as a shareholder, you may want to get the margin of the dividend be paid as compared to what was available. You know, if for instance the total amount of profit was 10 million, that means they were capable of distributing up to 10 million, but they may choose to distribute 5 million. That means that they distributed 5 million, but they were able to distribute another 5 million if they want. So we want to get to what extent are we covered and the dividend covered. So that is the what we call dividend cover. Then we have the limitation of ratio analysis. We normally have the various limitations. One of the major limitations is that use the historical information to assess or to make future decisions. We have probably decision or the information that we prepared last year, probably we may talk of 2019, and now in 2020. We are using the information that was prepared in 2019 to be able to calculate the ratio in 2020, and probably the same ratio are going to be used many years to come. The investor, when you are asking themselves, are we going to invest our money in company A so that we'll be able to get some profit 5 years to come? I want to invest money in company A so that we'll be able to educate my children maybe 5 years or 10 years to come. I'll be able to sell the shares so that I'll be able to educate my children. Remember, we are using historical information, the past, to be able to predict the future. The past may not always tell you about the future. Probably the company may be doing well now, but 5 years to come, it may have challenges that make the company go down. Or probably you refused or you say that you're not going to invest in a company that was not doing well, but come sometimes or some years to come, that will be the best company in the industry. Number two, you're also saying we may be comparing firm that are of different sizes. We are comparing firm A with a firm B to be able to know whether to invest in A or to be able to invest in B. The other question that you should ask yourself, are they of different, are they of the same sizes? Maybe company A was started 20 years ago. Company B was started 1 year ago. You cannot say because they are making the same sale, they are performing the same. Of course, given time, the company that was started probably 1 year ago, it may be able to, it's going to overtake the other company. So it may be misleading when you compare the company that are of different sizes, that are from different industries. Then you have number three, we may have different accounting policies. And remember, the accounting policies, they are subjective. You know, we may decide on what to do with the company. For instance, we may decide on to charge a certain expense. We may be saying that company is performing well, that company B, yet the difference is only as regard to the accounting policies which are subjective, and in a case the other company can reverse the accounting policies in one way or the other. Then you have next, you ignore the qualitative aspect. We are only concentrating with the figures, but the other qualitative aspect that may affect the performance of the firm, for instance, the efficiency of the manager. We cannot just say because you are making a lot of sales that the best company. We must also look at other aspects in the business that matters. So it's not about the sales they are making now. You know, efficiency of the manager may tell about the performance of the company some years to come. It may be doing well, but probably the company is now being managed by low quality managers. So we may be able to predict, even if you are doing well, as long as the manager is not efficient, we may predict that the company may not be doing well some years to come. The last thing we have, the ratio are normally computed at one point, but situation may keep on changing. So we compute the ratio in the month of December, or probably want to concentrate what is happening, or we want to compare the total asset that you have in a certain particular time as compared to the amount of sale. No, that's the asset that you have on that 1st of December. But you don't know what is going to be there on 1st of January. Probably we have so many assets on that 1st of December, or when you close the year, but started the year, we saw half of the asset. The situation is going to change. So they are going to just be computed at one point, but the situation may keep or changing. So even as we analyze the ratio, we must even know the ratio you are going to use at a particular instance. For instance, you may be asking yourself, when do you know whether to use the current ratio or liquidity ratio, or when to use profitability ratio, or to when to use the other type of ratio? It all depends with the scenario. Probably in case of financial institutions that are giving credit for short period of time, they may decide to use liquidity ratio. You want to measure the capability of the business to you to pay within a certain given period of time. In case you're an investor, you are asking yourself, should I invest in a certain company or not? You may not limit yourself to what is happening today. You may not limit yourself to 1 month or 1 year. You want to look at what is going to happen 5 years to come, 10 years to come, 20 years to come. So in that case, you cannot use liquidity ratio. You are going to use profitability ratio. So the kind of ratio that you're going to use depend with with the user, and secondly, with the situation. And with that, we come to the end of our lesson. And in case there are any question or you require any clarification, you can post online, and I'm also going to give you a comprehensive example so that you can be able to assess whether you are able to use the various type of ratio or the financial statement to compute the various type of ratio, and also to be able to make decision out of the many ratio that may calculate. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.